Hi, it's Trader Jessie here, and in this quick video, you're going to learn the top 3 ways to avoid triggering the pattern day trader rule as a stock trader. This information is very important if you want to day trade stocks with an account that has less than $25,000 in it. A pattern day trader is a term defined by FINRA, the Financial Industry Regulatory Authority. You might recognize the SEC better, the Securities and Exchange Commission. They're the organization that oversees FINRA. FINRA's definition of a pattern day trader is anyone who trades 4 or more times in 5 business days, provided the number of day trades are more than 6% of the customer's total trading activity for that same 5-day period. What this means is that you must have a $25,000 account or higher to day trade stocks. So if you have more than $25,000 to trade with, you're fine. But if you don't have that much money, as many don't, especially when they're just starting out, what can you do? Here are the top 3 ways to manage with less than $25,000. Number 1 is to adjust your style of trading to reduce the frequency. This way, you can do 3-day trades during a rolling 5-day period without triggering the rule. So if you adopt swing trading and use higher time frames, for example 60 minutes and above, you can work your trading around the rule until your account is large enough to avoid it entirely. The second way, and this is a bit of a trick, is to use multiple brokerage accounts. For example, if you have $10,000 to trade with, you could open 2 $5,000 accounts. Then in each of these accounts, you could make up to 3 trades per 5-day rolling period, meaning you could make 6 day trades in total. And you can further increase this number with more accounts. In the past, this method would have been extremely inconvenient, but with technological advances and the ease of opening accounts today, this method is feasible. However, with this method, your ultimate goal will likely to be to increase your account size to $25,000 and then consolidate your accounts into one that is fully eligible for day trading. The third way to day trade stocks with less than $25,000 without triggering the pattern day trader rule is to consider finding a prop firm to trade with. Some require you to be in person, but others allow a virtual presence. These firms often allow a small account minimums, and you can trade with the prop firm's capital, which gives you full day trading buying power and no day trading limit restrictions. Often, there is a very discounted micro commission structure as well. So those were the top 3 methods of avoiding the pattern day trader rule, but I'm going to add one bonus tip for you. I know this video is about trading stocks with an account less than $25,000. But if you're looking to trade the stock market as a whole, you may want to consider trading index futures instead, especially the E-mini S&P 500 or the E-mini NASDAQ 100. Day trading futures does not require a $25,000 account minimum, and there are leverage and possibly certain tax benefits that may apply. However, a word of warning here. Leverage can be a double-sided coin, and high leverage can also translate to high risk. So do make sure that you know what you're doing before you put any real money at risk in the futures market, and make sure you trade with a simulated account until you're ready. So in this video, we learned about the pattern day trader rule, what it is, and how it affects stock day traders who have accounts under $25,000. Then, we learned the top 3 methods to avoid triggering the rule. Number 1 was adjusting trading frequency to only 3 day trades per rolling 5-day period. Number 2 was opening more than one brokerage account to increase the number of potential day trades during the rolling 5-day period. And number 3 was considering trading with a prop firm that has a small account minimum and allows you to trade with their firm's capital. We also covered a bonus tip, which is to consider switching to futures, especially the E-mini S&P or the E-mini NASDAQ, which have lower margin requirements. What we learned in this video is a great example of why understanding the trading industry and its regulations is so important to your trading career. Sometimes, regulations like the pattern day trader rule that at first may seem to create impossible situations can instead turn out not to be the roadblock we first thought, especially if we have innovative methods to deal with them, like the 3 ways and 1 bonus method we just learned in this video. I hope this information has been useful to you. Until next time, trade well.